Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How's it going out there? I thank you for watching. I know you guys probably have other things to do right now, but if you're sitting around watching videos trying to learn a little something, well, I applaud you, and I appreciate you watching our videos, so a big thank you for that. It's just a quick series that we do. We call it Fin Tips, as the intro showed you there. Just a real quick video to cover something different, maybe teach you something new, and you can get back to life, because I know it's busy right now. But so let's dive into this. The Fed recently cut rates to 0, actually, and I'm just going to show you. Let's quit wasting time here. If you go down to, you look up the rates here. Here is the last couple years looking at the Fed rates there. Obviously, they were raising rates. They thought the economy was doing better. They did a series of raises there that did quite well. But ever since lately, they've been cutting the rates little by little. And so I've been getting this question a lot. Dustin, should I refinance? Clients are asking me left and right. Hey, I'm not going anywhere. Going to stay in my house. Should I refinance? Haven't refinanced 5-6 years. I bought it 6-7 years ago, whatever. Wondering if I should refinance. And my answer is not yet. Hang in there, because guess what happens when the Fed cuts rates? First of all, that's not directly tied to mortgages. Yes, it does affect them in the long run, but it's not directly tied to them. But interest rates do come down. But when they initially cut rates, did you know mortgage rates actually go up? Kind of interesting, right? To prove it, let's take a look here. We've got the Fed cutting rates here on the charts. We'll throw in the 30-year mortgage over the top of it here so you can see. Let's take a look at what happens here. Last time the Fed cut rates was right here. So they cut from 2.25 upper end to, or lower end 2.25 to the lower end of 2. The Fed has a quarter-point range. So you've got 2% here. When they cut rates, look up here at the 30-year mortgage. It ticked up for a little bit. It eventually started rolling over, but right away, the response was for interest rates to go up. Why do you think that is? That's kind of interesting, huh? You would think that it would start to weigh on interest rates, and it does eventually. But let's take a look. Now we come over here to when the Fed cut rates to 0, right? The low end of the range at 0. And what's happened? We're down here at 0. The next stop is inverted, like the other countries. But anyways, look. The 30-year rate is actually ticking higher at the moment. Now, we're pinching pennies here. We're not talking a massive change. So by all means, don't let this scare you. But we do see a small uptick in the mortgage rate, currently 3.5% at the national average there. So, actually, it's 3.65%. So what is the deal? What's going on there? Well, I'll tell you, it's inflation. Imagine you're the bank for a second. When the Fed cuts interest rates, you are worried that inflation is going to go higher. So let's take a look. And that actually does happen. Inflation, your light blue line here. When the Fed cut rates the first time, right about here, you can see inflation crept up and has continued to do so. The Fed likes that. That's actually what they want. It's not a bad thing. And inflation's super low right now, so we're not like panicking about this. But now that rates have been cut to 0, inflation is expected to rise again and is already starting to do that. My data's a little behind here. But let's think about this. Why would rates go up? If you are the bank and you are making money by loaning money out to people, well, that money is coming back to you later. And so because you're taking the risk of loaning the money to somebody, you charge an interest rate, the 3.65 that we saw at the moment, for the level of risk that you're taking. If you think you're taking more risk, you might charge 4.5, whatever. But when you loan the money out, that's the return that you expect in exchange for the risk. However, if I loan you money as the bank for 30 years, and you're paying me back little by little, well, if inflation goes higher, that means the value of the dollar you pay back to me is worth less. If the value of the dollar that you pay back to me is worth less, that eats into my profit margin. And if it eats into my profit margin, then I'm going to piss off my shareholders. If I don't keep my shareholders happy, I'm going to lose them. My share price is going to go down. So it's this trickle-down effect. If I loan you money for 30 freaking years and inflation starts creeping higher, you're paying me back technically less money. I'm making the same 3.65%, but the dollar is worth less. And because of that, when the Fed cuts rates, inflation is expected to go higher. The Fed has actually said they will like this if inflation goes higher. The banks realize that and say, we need to adjust slightly. By adjusting slightly, they're getting back their exact return or as close to what they can expect. So the banks feel like inflation is going to go higher. Because of that, they charge you a little bit more. In the short term, that does tend to give you a little spike, but then you see it bleed back down, or we have in the past. I don't know if we've hit rock bottom here, and this is as far as they'll go, but that gives you an idea of how this works. So When the Fed cuts rates, interest rates go up, they're expecting higher inflation, and now you know. That's your economics lesson for the day. Anyways, just a short one here for you today. I do appreciate you joining me here. If I helped you in some way, hit the subscribe button, thumbs up button. Check us out at Jazz Wealth, where financial advisors have already shared this information with customers in our weekly class that we do for them, and happy to help you guys as well. So check us out. We're a small company. We're out there fighting for business, and I'm fighting by teaching, right? The more I can teach you, the more you learn. The more you learn, the more comfortable and confident you are, and that's my job as a financial advisor, not to just invest for you and go play golf or something. I don't do it. Enjoy. Thank you.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.